Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the upcoming CPI report and FOMC meeting this week and the general implication on risk assets. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out Into the Cryptoverse Premium at intothecryptoverse.com. Year over year inflation is coming in right now at about 7.7%, at least when you look at headline inflation. General consensus, though, for the CPI report on Tuesday is 7.3%. Expectations for core inflation on Tuesday is 6.1%. The market is currently expecting on Wednesday a 50 basis point rate hike with a 75 probability of occurring and a 25 chance of it actually being a 75 basis point rate hike. My general expectations throughout this year is that the federal funds rate would continue to climb higher despite a lot of people's expectations, and that we would likely make it to the 4 to 5% range by the end of the year. I do think the terminal rate, at least in the short term, is probably around 5%. And if I had to guess, I might even say the range is somewhere between 5 to 5.5% for the terminal rate on the Fed funds rate. Now, will the next interest rate hike be only 50 basis points? If you go back and look at the prior videos that I did, I was fairly, I expected that we would see 75 basis point rate hikes essentially every single time. Now, I actually do think the highest probability in agreement with the market here is that it will likely be a 50 basis point rate hike, not only because the market is expecting it, as you can see on this chart, but also because Powell said as much that they're likely leaning towards lowering the interest rates as early as December. And if that's the case, then we are in fact in December, and they reserve the right to cut it down to 50 basis points because of the lagging effects that interest rates have on the US economy. My general expectation is that it likely will be a 50 basis point rate hike, finally coming down from the fourth 75 basis point rate hike to get us down to 50, unless inflation comes in hot. So if inflation comes in at either expectations or below expectations, I think that the Fed funds rate will likely only go up by 50 basis points. However, if inflation comes in very hot and well above general expectations, then I still think the Fed reserves the right to go for a final fifth 75 basis point rate hike. And if they do go with a 75 basis point rate hike, I think that will be the last one for quite some time, and that they would certainly lower it after that. My expectation, though, is that unless inflation comes in extremely hot, they will go with a 50 basis point rate hike on Wednesday. And so I think it's worth closely watching tomorrow where inflation comes in. So it should come in on Tuesday, I shouldn't say tomorrow, it depends on when you watch this video, but it is going to come in on Tuesday, December 13th. And depending on where it comes in, I imagine could have implications on what the Federal Reserve decides to do. Now, remember, in the short term, a surprise to the downside, if inflation comes in lower than expected, could send risk assets higher. The main thing that we have to constantly remind ourselves of is that these interest rate hikes that we talk about, inflation, while they are meant to bring inflation back down, you'll notice that every single time, for the most part, that inflation goes up, we end up going into a recession while it's high or right after it comes back down. And the reason is because, in my opinion, of course, is that the Federal Reserve has raised rates and it pushes the US economy into a recession. Okay. And so right now, we're not seeing any clear signs of a recession yet. The unemployment rate remains low. Despite the best efforts by the Federal Reserve to loosen it up, it still remains somewhat low, but inflation still remains somewhat high. And we know within the business cycle, the unemployment rate is usually one of the last things to finally go up to sort of complete that cycle. If you go look at interest rates and where they currently sit, again, we know the Fed funds rate is already at around 4%, but furthermore, I think what you should especially take note of is just how quickly that the Fed funds rate has gone up this hiking cycle. And we know that based on what we've seen historically, it can take about a year before these interest rate hikes to be felt throughout the economy. So while the short-term implications of lower inflation and potentially a lower interest rate hike, while it might lead to some relief in risk assets in the short term, I still think it would be somewhat premature to celebrate the end of the bear market until we see the longer lasting effects of these interest rate hikes in 2023. Remember, if you just simply go take a look at the yield curve and the spread on the yield on some of these yields, if you look at the spread on the 3-month and the 10-year, or the 2-year and the 10-year, what it shows is a fairly deep inversion. And these inversions are often followed by recessions, which is where the S&P 500 normally bottoms, with the exception of the dot-com crash, where it actually bottomed after the recession, probably because of what actually happened in 2001, if you think about what was going on during that time. So my general expectation is that as we get out into 2023, we will likely continue to face macro headwinds, because we're going to have to sort of face up to the music that all these interest rate hikes will likely have an impact on the U.S. economy, and it likely will send us into a recession. In the short term, though, if inflation comes back down and the Fed is a little bit less hawkish on their interest rate hikes, you could continue to see a little bit of relief to risk assets. I mean, I think Bitcoin is right around 17.2K right now. So it's basically relatively unchanged over the last few weeks. It's moved up a little bit. And if it continues to push higher, we still, of course, have the major resistance of the bear market resistance band that sits just above $19,000. But anyways, hopefully that is at least somewhat insightful. CPI on Tuesday, FOMC on Wednesday, likely going to be 50 basis points unless CPI comes in well above expectations. And if that's the case, if it does come in well above expectations and we get another 75 basis point rate hike, then I think you're likely looking at the S&P, sort of just continuing on with its structural bear market. Okay. If on the other hand, it comes in lower and the Fed provides a somewhat dovish surprise, then you could see risk assets continue to rally. But even if they break this trend line, we still have to face the music in 2023 of lower earnings, likely lower earnings, and a potential recession. That's where we currently stand. That's my general expectation. Hopefully you find it useful. If you do, make sure you check out intothecryptoverse.com. We do have Into the Cryptoverse Premium there. We also have a Telegram channel. You can find a link to that in the description below. Thank you guys for tuning in. Make sure you subscribe, and I'll see you guys next time. Bye.